I'd like to introduce Nadia. Nadia is the Director for Food Security and Agricultural Investments for the Development Finance Corporation. Nadia is the Director in DFC's Office of Health and Agribusiness, focusing on origination and structuring debt and equity with private investors, debt funds, NBFIs, microfinance, and fintech, primarily in the Africa region. Prior to this role, she was a principal energy and infrastructure investment officer at the Inter-American Development Bank and the head of project finance at Credit Agricole, Brazil, and vice president at the Santander Bank. Wow, these are quite strong words. So Nadia holds a master's in finance from EM Lyon, France, and a master's of science in finance from George Washington University. Nadia is fluent in English, French, Portuguese, and Spanish. Wow. So welcome, Nadia, and she will introduce you.
Thank you, Joseph. I feel very embarrassed now. You explained my whole mini bio, and I have nothing else to talk about for me. But no, thank you very much, ladies and gentlemen, for being here today. I'm going to be your moderator for today's insightful conversation. I'd like to welcome our panel discussion on ESG integration, which is shaping sustainable investment strategies. To begin, I would like to invite each panelist to come here. So Anushka, Julian, Avinash, Christian, and Kapil to join me here on stage. I don't bite. Yes. Okay. So thank you very much, everybody. Our topic is timely and critical as we navigate the evolving investment landscape. To begin, I would like each of the panelists to introduce themselves and provide a brief overview of their perspective on ESG integration in their institutions. Christian, I'll start with you.
So introduction and...
introduction and how ESG applies.
We all trained it before. So Christian is my name, very nice to meet you. I'm one of the founders and partners of AFSIC Impact. AFSIC Impact is an agriculture, afforestation and agriculture fund in 3 countries in Africa in 6 projects. We have raised funds from Europe predominantly and are in engagement with 2 DFIs from Europe and also hopefully others. AFSIC Impact stands for Agri-Silvicultura. For the ones who learned some Latin, I unfortunately had to. And basically, Latin means field forest culture. What do we do? 25 years ago, I was meeting my friend and nowadays partner, Carl. He's coming from a forestry business, which is called Haslacher. It's one of the biggest cross-laminated, so lamination of timber businesses in the world, actually. And he said, as a family, I want to invest in Africa. I said, well, you must be crazy. That's 3 years ago, sorry, not 25 years ago. And he said, maybe. And out of that, we basically raised a fund called AFSIC Impact Forestry Fund. We have currently 30 million. And we started right from the beginning, the question, how do we integrate ESG? So we wanted to be, and we are, a SFDR 9, so basically European Regulation Article 9 fund, which is quite important, number one. Secondly, we thought, how do we manage basically getting measured our ESG criteria and also getting penalized in case we are not compliant to it? And the question that we answered is the following. So we basically took measures of good forestry, good agriculture worldwide, in particular on World Bank, European Union, and the FAO, the Food Organization, World Food Organization, and agriculture. And basically what we did is these 180 ESG criteria we basically transformed in not compulsory, but must have. These ESG criteria are basically externally monitored by external audit companies. Then we have an independent ESG board. I just met one of the board members who's this morning of the ESG board. She's, for example, from JP Morgan and works for the Metropolitan University of London and in many ESG boards. They have the power to take away the GP's carried interest as per the limited partner agreement in case we're not compliant with that. So the point I'm trying to raise is we all have heard of this carrot and stick model, basically with the poor donkey, basically to motivate him to walk and to stand and so on. And that's exactly what we wanted. So we wanted to have a positive motivation on compelling it, of being compliant with our ESG criteria, number one. And then in case we're not compliant with it, basically get deducted our carried interest, so have the pain. And everything that is withdrawn from us, and that's not our decision, that's an external decision, is basically going back into the project areas where we are. And that's just to a little bit of advertisement. Ethiopia, Congo-Brazzaville, and Angola. My two partners responsible for the forestry, I'm the boring guy not being responsible for the afforestation and agriculture, but they are on the ground in Ethiopia and Luanda. That's it. I hope it was...
Thank you, Christian. Yeah, no, perfect. Julian.
Hi, everyone. I'm Julian Draper, partner at Knife Capital, which is a South African venture capital firm HQ'd in Cape Town, but we also invest on the wider continent. We are a sort of more standardized VC investor, commercially minded. However, we do take our ESG thinking and all of those elements quite seriously. We launched in 2010, and that was Knife Capital Fund 1. We're now into Knife Capital Fund 3, which we closed last year, and currently in talks for Knife Capital Fund 4. But we sort of focus areas are what we call South African Series A. So we're tech agnostic, but we've done a lot in the edtech space, AI as a service, SaaS businesses, IoT, you name it. Sort of Series A positioning for South Africa is sort of $500,000 to $2 million in terms of ticket size. So we're earlier stage tech businesses at that point, but obviously in that growth curve. Our fund we closed last year, which is a $50 million denominated fund with a Jersey structure, Jersey UK, is a later stage growth fund. So looking between $3 to $7 million ticket size. Again, tech agnostic, following the same principles and investment ethos as we have in the earlier fund. And how that all sort of brings into the ESG piece is that we traditionally have always focused on ESG, but I would say probably more so the G of the ESG piece. The governance element for us has always been critical. It's always been very, very important. Interesting insight when we exited Fundamo to Visa in 2011, when we looked at the VDR analytics, the DD team from Visa actually spent 52% of their time in the data room in the ESG folder. So, we know how important that piece is. We've also been fortunate to exit, more recently, a couple of businesses to US acquirers, and the ESG piece has been questions raised around that. It's played a key role. I think the fact that we're a South African-focused investor on the social piece, you have the Black empowerment movement and how that can play a critical role. Obviously, if you have a company that is servicing Black empowered or high-level BEE customers, if they're suddenly being acquired by a US or international investor, that comes into play in terms of being able to actually keep that level of grading and be able to keep serving those type of customers. And of course, with Fund 3, we're fortunate to bring in DFI investors such as the IFC DEG Alliance through Africa Grow, and with that becomes even more focused and stringent requirements around ESG, how we bring that into our investment thinking, and then also in terms of monitoring, reporting, and so on and so forth. And it's been an interesting journey. I'm the ENS officer for Fund 3. I'm also a custodian of ESG at Knife Capital as a whole for the group, and also our earlier stage businesses. And we've done quite a lot in the last 12 months, working with a couple of third parties, supported by the DFIs to really evolve our ESG thinking and ESG strategy, not only for Fund 3, but across the entire portfolio and how we think about things. And for us, there's opportunity there, as well as doing it properly and where it can lead to in terms of exit-centric business building as well, which is very much how we do things.
Oh, thank you, Julian. Hope we'll be able to dive into a little bit more on that. So, Kapil.
Thanks, Nadia. Hi, everyone. My name is Kapil Kanungo. I work with Incofin Investment Management. Incofin is an impact investor based out of Belgium, headquartered in Belgium, but we have offices across Nairobi in Kenya, but also Chennai, Delhi, Phnom Penh, and Bogota in Colombia. So we invest in 60 plus countries around the world, manage close to 1.5 billion in assets across private debt and private equity, and all of our investments are Article 9 impact investments. We invest in 3 sectors. We invest in financial inclusion, where the focus is to serve underserved communities, especially rural communities and women. We invest in agri-food businesses with a special emphasis on SMEs that are, or smallholder farmer cooperatives that are looking to do climate-smart agriculture. And we've recently also started investing in access to drinking water, where the criteria is safe and affordable drinking water. So it's not just safety, but also affordability of drinking water. So this is what Incofin does. We've been around for close to 20 years. Our thinking on ESG is, I would say, fairly simple. One is we think of the principles are A, B, and C. So A is act to avoid harm, B is benefit stakeholders, and C is contribute to solutions. And all 3 are important, and it's an easy sort of acronym to make sure that everybody in the company understands, all of our investment managers understand this. So A is, so for all of our investments, we want to make sure that we're actively looking to avoid harm. So that's more exclusionary. B is benefiting stakeholders. That's especially important in contexts where multi-stakeholder partnerships come together. And when you're looking at issues like climate, for instance, these are not single sector issues. I mean, you can look at climate and agriculture, but climate and agriculture requires participation of multiple stakeholders. So we look at actively benefiting all stakeholders that are involved. And third is contribute to solutions, which is very much the thesis of impact investing. So we want to make sure that all of our investments are actively, with intention, contributing to making a positive impact in the society. And the final point on that is we apply this philosophy because we think there's really no trade-off between ESG practices and in impact, which means that high impact alone does not mean that we will accept questionable ESG practices, right? So that's important. We need both. So that's a little bit about my firm and our thinking on ESG.
Thank you, Kapil. Avinash, please.
Thanks. Pleasure to be here. My name is Avinash Mishra. I'm the Chief Investment Officer at Global Innovation Fund. We're a multilaterally funded, independent nonprofit. So despite what the name suggests, we're actually a charity headquartered here in the UK, funded primarily by government donors. So the government of the UK through FCDO, Sweden through CEDA, in the past, DFAT Australia, USAID, et cetera. So we manage essentially public money, and we deploy that as both grants as well as investments, which are typically early stage seed to about Series A investments in sub-Saharan Africa, South Asia, and Southeast Asia. Our mission is to improve the lives and well-being of those living on less than $5 a day, and particularly over the last several years, do that in an equitable manner to make sure that women and girls are not left behind, and increasingly with a focus on climate adaptation and resilience, which threatens development progress anyway. So that's just a little bit about our organization. We've deployed over the last 10 years about $120 million in 70 plus projects in 35 countries, which together are on track to impact and reach 150 million plus poor people globally. ESG has always been, from day one, given that we are custodians of public money, been a very, very important subject area. In fact, Katie, who heads our ESG function, she was employee number 3 in the organization, long predates me, which goes to show how important this function has been from day one. And the way that we think about it is because of the nature of projects and innovations that we're investing in, these are often frontier markets, untested ideas, communities which are anyways vulnerable and at risk. This is almost as much an art as it is a science. So our ESG colleagues, there's 3 of them full-time in the team, which may not seem like much, but that's 10% of our workforce, get involved in investments from day one. And they're part of the deal teams, looking at active diligence and trying to understand the businesses that are underlying as well, because we really see the ESG risks as fundamental to business risks or impact risks as well. There's a strong correlation between everything. So that's one part of it, get involved from early investment process. The second part of it is try to be solution-oriented. So yes, the function is trying to assess the underlying risks and potential avenues for where some downside might occur or some risks might present themselves. But we also understand that with these early-stage organizations are on a journey, they wouldn't necessarily have all the answers and all of the solutions baked in. So the attitude for us always is, how can we be enablers of getting these organizations up the ESG curve to be best in class and ready for their growth journey. So as part of our investments, always we come up with an ESG action plan. So it's not just an assessment of this is where you're at in terms of your risk level, but here are the steps that you need to take. And we often, through our technical assistance and our in-house capacity, try and enable some of that work. And then just finally, it carries on to our portfolio management as well, where every 6 months we have a detailed risk review, which has a lot of focus on ESG. And again, the idea is to work with our investees and organizations in trying to see how risks are evolving and what we can do, not just in managing them from a portfolio perspective, but enabling the success of these organizations as well. So it's a 360-degree view that we take to ESG.
Okay, perfect. Thank you so much. Anushka?
Thank you, and a real pleasure being here today. I'm the founder of Risk Insights. It's a data science company. We were founded 15 years ago. I pioneered the first artificial intelligence machine learning model for ESG for the African continent. And how did that come about? So Risk Insights was developing models for a number of years, predictive risk models for expected loss calculations for Basel. And in 2017, I was working on a project for one of the large asset managers in South Africa. And they asked us to recalculate the alpha because of Reg 28 that had been promulgated in South Africa, where South African companies could actually invest larger amounts of capital internationally. And what had happened was this particular asset manager had BP on its portfolio. And because of the Deepwater Horizon crisis, BP had tanked, and it had a small little blip on this portfolio. But what I'd realized is that I started digging a little bit into this Deepwater Horizon crisis and picked up that environmental risk or ESG risk, because the Deepwater Horizon crisis not only had an environmental impact, it had a massive social impact. And South Africa was not actually looking at this to the level that it should have. And because I was calculating expected losses for banks, I'd realized that, well, if South Africa is not doing it, what is the rest of the market doing? The rest of Africa doing? And I said, well, this is going to have an impact on credit risk management going forward, onto everyone's portfolios in terms of debt, and on the discount rates of capital in the capital markets going forward, because if you're not taking into account ESG, then that's going to impact the capital markets in terms of investments and debt. So we started analyzing this. And as we started analyzing this, we also found that there was a massive geopolitical positioning that was taking place at the time in 2017. So Africa and most emerging markets were not taking ESG into account as rigorously as the rest of Europe. UK was slightly more backward, and it was during the Trump administration, who basically at the time in 2017, and I say this with, with caution, that in 2017, America was basically in climate change denial, right, through that administration. So we said, well, let's have a look at this entire greening, what is going on? As we started unpacking this, we realized that there was an alphabet of soup in terms of the whole ESG frameworks that were across the globe. There were over 200 frameworks. And today you have standardization in terms of the IFRS standards S1 and S2, and CBAM and CSRD, and SIC to some extent, which have paused some of the regulations. But we realized at that time there were no regulations. Rating agencies did not have the ability to calibrate their ratings to the risk that you were carrying. And that meant that if you couldn't do that, it would mean that the discount rates applied to Africa would actually be impacted massively going forward. So as I unpacked this, and being a knowledge-based institution, Risk Insights, and being 15 years at the time in building models on my own in terms of my own company, I thought that this is an extremely important piece of information and risk that needs to be unpacked for Africa. And so we used artificial intelligence and machine learning, an algorithm called TF-IDF, and today you use it on your phone. So every time you type out a sentence, the predictive texting allows you to pick up a whole lot of words to complete a sentence. And what we did was we used the algorithm to create a model that would be able to pick up the narrative of every listed company on the Johannesburg Stock Exchange. Why the JSE at the time? Because the JSE was the only exchange in the world that actually looked at integrated reporting as a listing requirement. And that gave us all the narrative, which today you call S1. So we got this like years later, but Risk Insights developed that in 2017. And then we took computer engineering and pinpointed the data in terms of what you actually reported in your integrated report. So as asset managers, we would be able to, as a risk scientist and risk data science company, we are able to see what are you actually empirically reporting based on ESG, and then you are able to, using the S1 and S2 regulations, actually look at the stress testing of revenue and financial risk going forward in terms of single materiality.
Oh, thank you so much for that. Now I'm going to start with a few questions, and then I'll open up for any Q&A that if we have a little bit of time. So the first question will be for Julian and Christian. So ESG integration help mitigate long-term risks such as regulatory and reputational damage. In your view, how are ESG factors identified, and how can they influence investment decisions? Just to be mindful of time, because I think we have like about
30 seconds for everyone. Okay. I think I said it in the introduction. We basically defined very clear criteria, ESG criteria, roughly 90E, roughly half of the 90, of the second half of the 90, so 45 S and G. They're very clearly measurable goals. These I see as evolving over time. You know, the truth is not today the truth for the next 16 years over the entire fund cycle. So you need to develop them further. That's why we have external advisors. They're externally audited, so we pay like Bureau Veritas, SGS, TÜV in order to control them on the ground. And in case we're not compliant with them, we get penalized. That's what I said. So we basically get deducted our carried interest, which is basically the investment performance. I think that is the clear demonstration of how that involves the investment decision. I think when you want to do things right, you basically need to incentivize the entire organization, and basically that's what basically governance is spoken. That's the point of governance, that basically you need to start from the top and basically have it basically sink into the organization. That sounds maybe not a good term, but ultimately that's how you link everything. And I think that's the key. And that would be the same for probably now linking to you. When you invest in your target companies, you basically inhibit on them certain standards before you actually invest in them.
Yeah, we have.
Yeah.
Sorry, go on.
Sorry. No, that was the introduction.
I was going to say, we have a very specific way in how we invest. So we're a tranche investor. Mm-hmm. So we will never give the full amount of capital in the first go. We'll do a gap analysis on the business. We do quite a thorough TD to do that. We do it across 6 or 7 different pillars, from commercial to team to financial to IP, legal, tech, environmental and social. And the governance piece actually always traditionally came in the legal bit. Now it's becoming more ESG rather than environmental and social in terms of the pillar. And so that is how we find there's you talked about it before, the donkey image of the carrot and the stick. But basically for us, the reason we do that is because we know, there are going to be certain things that have to be in the business as an absolute before any money flows. And then we have milestones associated across each of those pillars, because we can see there are gaps, and actually we know that if we can get those plugged and we can incentivize the founders to do that, we feel, one, it aligns us as investor with the founders in terms of partnership and growth. Yeah. B, we feel that the company is going to be better placed by the time all of these gaps are plugged for whatever eventuality that might be, whether it's the next fundraise, whether it's the next possible exit, or even in the ESG piece specifically, it's the risk mitigation. So, we're looking for where there might be some. And that's how and we're basically, the other piece I was going to say, there are strict criteria that you can follow. There are so many different standards out there. Unfortunately, I think I was reading a PitchBook article yesterday, and across their survey group, they talked of 70 different standards that these different PEs, LPs, GPs were following, which is crazy. Yeah. And it's a big problem. We try and stick quite specifically to a couple of them like SDGs, IFC performance, and so on and so forth. And that will also give you an outline in terms of what are the risks and opportunities. And for us, last bit specifically, we're investing in early stage tech businesses. So they've got to be relevant. And this is the other piece about standardization. The standards, is how relevant are some of these, because they're so broad. And actually for early stage tech businesses, they're relevant. And the big challenge is getting founders to understand this is not a box tick exercise. These are real risks, especially tech businesses. And there's more that needs to be done in identifying what those potential risks are.
Yeah. Nice.
One sentence only.
Sure.
For me, it's important, and I think you would agree to that. At the foremost, we need to deliver performance to our investors. So we are interested in profitability, and then we are, so to say, finance first investors and impact second. I think that's key. There is clearly in the market impact first and finance second, but my observation from the market, and the economic times we're in, that's a key thing. Now I'll shut up.
Yeah.
Agreed.
No, thank you. I think this is super helpful, and it's really, I think, how investors are looking at both from the return for the fund, but also in terms of the ESG to mitigate a lot of these and really drive impact. So, and I think what you're mentioning, Julian, in terms of the lack of standardization, I think it's a big issue. And I'd just like to turn the question now to Anushka and Kapil, and I'll let whichever wants to ask first. But really, there is a lack of standardization in how companies report their ESG metrics. And it really feels like every company, although there's general IFRS and so forth that are standard, you really need to customize it at the company level. So the question for Anushka and Kapil is, can you discuss the challenges faced in ESG data collection? Because that's really what is at the core of this, and how they impact the accuracy of ESG assessments?
Yeah, I'm happy to go first. So I want to pick up from where the gentleman left. One is, so for us, we're both sort of finance and impact, right? So there's no finance first or impact first. Both are important, and both are equally important for us. And what Julian was talking about right now in terms of lack of standardization, I mean, we see there are three challenges. First challenge is that there are different requirements, which is something that's been spoken about by different investors that they are imposing on their portfolio companies. Second is these requirements are ever evolving, right? So every 6 months, they're like, oh, you know what? Can we look at 3 other data points? Can we look at 4 other data points? And it's, the entrepreneur out there is actually doing business, right? I mean, ESG is a part of their business, but that's certainly not their full business. And the third thing is, even if they are ready and willing and able to get some of this data back, the problem is lack of systems. So especially in economies or countries where we invest and in sectors where we invest, I mean, some of the times the IT systems themselves are not capable of getting that kind of data, that quality of data, right? So these are 3 issues that we have seen while investing in the sectors and countries where we invest. That said, what are the solutions? So for us, there are a few things that have worked. First is really identifying where there's what's a no-go versus where there's an opportunity for us to adjust, right? So I'll give you an example. There is a company called Pamecas. It's a Senegal-based MFI that we invested in. We looked at that company throughout the sort of financial due diligence and then ESG due diligence, and we found that while everything was good, their social performance measurement system was not up to the mark. But we don't want to be exclusionary. I mean, one way to think about this is, okay, we're not going to invest in them. But for us, the idea was we still are interested in investing in them. So we put together a technical assistance budget for them so that they could work with us and bring their standards up to, say, a level where they work for us. So that worked out quite well. On the second side, there was I can't name it, it was a Nigerian agricultural company that we looked at, pretty large company. The finances looked very good. But we saw that in one of their business lines, they were also trading a herbicide, glyphosate, which was a tricky herbicide. It's legal in the areas where they were operating, but the EU has already banned it, right? So for us, that was a no-go. So that's where we drew the red line. We said, this is not something we're going to invest in. So it's important when you're looking at that data, right-sizing it, identifying what works and what doesn't work, and really working very closely with the investee company to make sure that you're developing their capability and capacity. Because ultimately, the idea is that much of the exercise that we're doing with our investees helps them with their business. Right? It's not a tick box exercise. It's not a risk reporting exercise. It's really an exercise where they see value in this data that helps them grow their business better.
Mm-hmm. Yeah, super helpful.
Just adding on to what Kapil has spoken about is the data is absolutely key, right? It's a currency. So if you're putting in controls and measures in terms of looking at a one-size-fits-all, it's not going to work. So firstly, Africa has a few problems in terms of ESG currently. So one is that the regulations have not been adopted in any country as yet at all. So there's a whole lot of pilots that are carrying on in terms of the actual regulations. Two, I've heard my colleagues speak about standards and frameworks and mixing them up, right? So there's a very big difference between a standard and a framework. So you can have 200 frameworks. You all can have frameworks that's sitting in this room, right? Mm-hmm. That doesn't mean that that standard is that framework is a standard. So you've got to ensure that you're understanding what is regulation, what is standard setting, and what is best practice, and what is a nice to have, as well as how do you differentiate and create competitive advantage, branding, but also taking into account the profitability and the economics. So we've moved using the data and what we've done over this last, people would say 200 years, but I would say over this last 50 years, we've moved from sheer capitalism into stakeholder capitalism. So it's still capitalism, right? It's economic still, but it is about how do you ensure that you're creating value using the data, using economic development, but at the same time ensuring that you're still creating innovation and progression in the world. And at the same time ensuring that we're taking into account the environment and as well as the well-being of all people, and taking into account how do you take governance to overlap that. And it's very, very difficult because almost all of us that are sitting in this room, and we can talk about data forever, but changing our mind and pivoting to this new era is extremely difficult because every one of us have actually been, most of us, at least 90% of this room, have been trained to look at the return on assets or return on equity. That's our grounding. And to move into the element of looking at impact investing and taking into account these 4 Ps of prosperity and people and the planet and principles of governance is extremely difficult to pivot the mind, because it means that you've got to change the way you do business. And how do you look at that data that's going to give you a view from prosperity going forward long term? So, and that's a very difficult thing, and especially asset managers that are looking at their portfolios long term, short term, and medium term, and that will determine those returns. So as much as everyone will talk about impact, that impact will come from exactly what your actual mandate is. And that's very important to hold asset managers to account for that. And if you don't hold them to account for it, what's going to happen is stakeholder capitalism is on the rise across the globe. This is not something that I'm talking about, but if you just put on the television, you will see how many activists are out there talking about everything that you are doing. And even though you would want to control your portfolio by saying, well, this is my investment, this is my alpha, and this is what I've done, if you don't control it in terms of these risks that we're talking about, using the data and empirically showing that this is what you are doing, it would actually end up where you would not have a portfolio. And that, for me, is the most critical piece of ESG and sustainability, of actually thinking with your heart. And if you can't think with your heart, you won't be able to think at all in this new world.
Well, yeah, that's very lovely words, and it's very, very true. And I think ESG, I think, especially in the last 10, 15 years, has picked up, and we're all trying to figure out how to adjust and to adapt it to our different institutions. My last question is for Avinash. Feeding onto this point is companies with strong ESG practices tend to have better operational performance and are more resilient in economic downturns. What are the risks and opportunities that investors should be aware of when integrating ESG into their investment strategies, and what tools can help further provide accurate ESG evaluation?
Thanks.
Oh no. We barely started. Yeah, no, I know.
Yeah, I was just about to thank the panel.
We just started, like,
be done with that.
heating up here.
Well, that's an important question. I think I'd just like to build on what my fellow panelists have said around, this idea of being returns first. And Anushka, you talked about this wiring that we have in terms of return on equity and generating returns. I would say that's the opportunity, but that's also the risk. It's the opportunity because worldwide capital markets are moving in that direction. Whether it's public markets, there's now some pretty reliable data available across markets that ESG performance does correlate with market-beating returns. You have access to exchange-traded funds, et cetera, which have an ESG strategy, which people like you and I can put our monies into, and so people are voting with their feet in terms of those kind of strategies. So it's very clear. All of us care about ESG. We've talked how our LPs care about ESG. So that's where the capital flows are moving. So that's the opportunity part of it. I think organizations which are able to build this particular muscle and this capacity to do this better will be better placed to access this capital, grow and generate returns, et cetera. The risk side of things is also, unfortunately, related to sort of this financial return seeking behavior, which is to say, when it's time to make the tough decisions in terms of where that investment capital goes and what the use of funds is. And that's where the rubber meets the road, and that's where it becomes really difficult to justify who pays for the cost of doing ESG. Because there is a cost to it, not just in terms of diligence, and of course there's a diligence cost to it, which we all sort of have to do. But as I talked about earlier, if we have to get organizations up that curve and build that capacity and improve ESG practice, there's a cost to it. And we're all guilty of it. I mean, I am fortunate that Global Innovation Fund is a nonprofit. For us, we have a little more leeway and luxury in terms of how we can create TA budgets and support organizations, but that's not always the case. I think that capacity for fund managers to deploy that kind of support is limited. And then we're sort of essentially in this journey of pushing downwards the expectations. So the markets, the limited partners, the DFIs are pushing fund managers are pushing their investees without there being a clear sort of accountability in terms of who pays for getting this done. So that's where the risk lies in terms of, I think it can go down that route of becoming a checkbox. That's why there has been some backlash, especially in the US in the last several years, where ESG became a taboo word for a while. But if we want to avoid that and avoid the sort of greenwashing label, then we need to solve for this question of who pays. And if the answer to that is it's always the companies that pay, I'm afraid that's not going to lead to solutions. The capital markets need to make room in their sort of return expectations to say that this is an investment that will go in. It might mean in the short term the returns are muted, but this is a long-term sort of play where this will play out and generate the additional alphas, et cetera. So
yeah, no, that is a very good point. I have a last question for anyone who wants to answer this on the panel. If you could change one thing about the way ESG investments are approached, what would it be? 30 seconds each. How's that?
I'll take 10.
Okay. We'll start with Anushka if you want, or not? No? Okay. We'll go with Kapil first then.
I'll take 10. ESG is not only risk mitigation, it is a return enhancer. Mm-hmm. That's a big shift that I think we need to look at. Absolutely.
I will go the next one. I think it's all about the license to operate. So if you want this license to operate for the future and generational income, generational profitability, then you should be looking at ESG.
Yeah, very good.
I would just go back to what I said in my opening remarks. It's an art more than a science. Yes, there are frameworks and toolkits available for you to organize your thinking. There's no substitute to understanding the context, understanding the markets, and being on the ground. So ESG needs to be embedded into the investment process.
Yeah, that's very good.
I think for me, it's about relevance. So as I've touched on it a couple of times, especially for us in the VC space, there's been a lot more done around private equity, larger deals, listed companies around that. Mm-hmm. Regulations impact more the bigger companies and listed companies, but for earlier stage VC, there's less been done there. And I think the challenge is making it relevant for founders to understand there's opportunity and what those risks are as well that they can then counter and mitigate against. And the more we can do there, the more it's going to filter up as well as these companies grow.
we need to engage much more investors. We need, across all asset classes, across all types of investors, that people are getting engaged in ESG and really look into the differentiation of the different products, get engaged, take time, understand. And that's true for retail customers, that's true for funds, that is true for pension funds, that's true for DFIs, and that is true for private capital of any type and institutional capital. That's what I think. So get engaged and get it across all asset classes and across all investor types. Thank you.
No, thank you. This is all the buzzwords we've had here. It's very, very, I think put together, it's going to be very helpful. Do we have time for a question, or does anybody have one question? Question? Yes, please go ahead.
Just a quick question. So if you assume that ESG impact investing is going to go from sort of nice to have to must have, if you like, either because of the risks that might be associated if you don't do it, or because it makes sense from a return perspective, do you think you will be seen as one of your USPs will be that impact side of things? So you might be invited into co-investments for, by more purely commercial investors in order to bring that expertise, and that will ultimately enhance your deal flow and ultimately your returns to your investors.
Yeah.
Because that's one of the things I would be pushing if I was in your position, because I'd expect that might hopefully emerge.
I can say something towards that, but just in terms of fundraising, we've had a couple of conversations as Knife Capital with a couple of parties that are impact focused, who have argued that if we can somehow co-raise a fund together, they can bring in the real specialist impact side of things and the ESG side of things, and we can do what we do as a commercial investor. So while we've thought about it, we haven't gone down that pathway, but it's definitely a conversation that's been had and people are having out there.
Co-raising a fund, but just co-investing.
But it's, I'm talking beyond that. But yeah, the co-investment side, I mean, people are always looking for strategic partners, so it depends when the time is right for that.
Just to conclude, I think your point is very relevant, and I think that commercial banks are moving very much forward also on the part on ESG. It's very much integrated in their business lines. And we at DFC, for instance, we're working with a group of commercial institutions on a $500 million raise, which is a sustainable linked loan. So it's a little bit linked to what you were mentioning in terms of like if this company achieves certain milestones in terms of ESG during the life of the loan, then they get, I would say, a concession in terms of their interest rate. So I think that it's moving towards a real partnership, I would say, according to all investors. So, yeah. Thank you very much. Thank you very much, the panelists. Thank you very much, everybody, for being here.